네, 미국 시카고 선물거래소와 월가 현재 동향을 생생하게 전해드리는 월가 트레이더 버니의 미국 주식 시간으로 돌아왔습니다. 아무래도 현재 계시는 버니 씨께서 자세하게 미국 주식 상황을 좀 살펴드리고 있는데요. 재무 컨설턴트로 계신 버니 씨와 화상 연결을 해서 생생하게 미국 주식에 대해서 알아보도록 하겠습니다. 오늘의 주제 같은 경우는 최근 이 변동성이 큰 시장에서 대응하기 위해서 시장 전체를 볼 수 있는 시선이 필요할 텐데요. 그런 시선을 갖고 싶은 투자자분들에게 도움 말씀 주실 내용 준비를 하셨다고 합니다. 거시경제 환경이 현재 시장에 미치는 영향 지금 바로 만나보시죠.
So let's think from a macroeconomic perspective. Let's look at different sectors of the market and overall how the macroeconomic environment is affecting the markets right now. So what we can see here is that it's not just one sector, okay? So our S&P is right in the middle, and we can see that if we take out energy's been a good performer. The index is a little bit worse. If we take out technology, the returns are even better. So what we want to really identify is that overall, this last downturn that we've started to set here has been affecting all the different sectors of the market. And what we've seen in the last, say, 3 to 4 weeks is the financial sector, the banking sector of the market is now broken down. Some of the energy sector is now broken down. We had oil up to $120. Oil has gone down to $98 and it's back up to $104, $105 a barrel. But we've had some setbacks and we've had some erosion in stocks that had done well but can't really maintain it in a market that's been sliding down. One of the other things is if we have a recession, and I don't know whether we're going to have one or not, okay, in those periods we've had a tendency to really drive down. Just because people are talking about a recession doesn't mean, and I think the average person, when they listen to what goes on the network news stations, the business news stations, they think we're going into a recession. Well, we'll find out whether we do or we don't. But you would think that we would have a larger decline. Now, so far this decline, you can look at the high beta stocks divided by the low beta stocks, how far down they are. So far, they're only down about 22%. They've had much bigger declines prior to that. But maybe what's going on is that that number, 22%, may be sufficient. We may not go down significantly more than that if all of the stocks break down and the high beta stocks break down not significantly more than the other stocks do. Now, what we also want to say is, okay, so let's say we go into a bear market, right? And then we come back out. Or let's say we go into a market setback and then we start to come back out. Once we come back out, what we want to do is have a high degree of stocks holding within 20% of their 52-week highs. So once the market starts to do better, we need to have 70% of the stocks be within 20% of their 52-week highs. So in other words, we're not having stocks breaking down and going down 40, 50%. In a positive market, stocks hold within 20. 20 is still a decent setback for a stock price. So what we need to do is have a high percentage of that. And what we've done so far this year is we get below it and we can't get above it. Now, that makes sense to me because I still think we're in a corrective nature here, and I don't think the rally that we'll see is going to be fairly significant until the second half of this year. But I want to monitor that to be able to identify, once we start to come out, to hold the market to that belief that we'll have 70%, because that's a way that we can measure the risk that we want to take that the stock market doesn't continue to break down. If we look at our PE ratios, when we've set bottoms before, we've set bottoms in the mid to low teens, and right now we're down from, say, 23.5% down to 17.8%. for PE ratios. Is it low enough? I don't know. It's getting better though. If we get down to 15, 16%, I think that might be fairly significant, and that would be basically a 3 to 4% further decline from here. These numbers are basically back in early March, so we need to update them, but we can't update them until we get all the first quarter earnings releases out. This is a chart I've shown before, and what I also want to believe is that when the market is bottomed, what we really see is very few people owning stocks on margin. And I just don't think we're down low enough yet to be able to identify that we have enough people that have exited their margin capacity for owning stocks on margin. One other thing that we think about, if we think about margin, look at what happened in the bottom of the market. This is a Google search, okay? So this is just a Google search. How many times did we search for margin calls? And what we found is that in March of this year, we had a big pop in that search for margin calls. I'd like to see that search go higher again. I think it's time to start looking at that to be able to identify that that should happen over the next couple of weeks. If I just look at the debit balances, the margin balances, we can see that there's just all the way from 1997, so the last 25 years, there's been a positive growth. There was an acceleration after COVID in 2020 and 21. But let's think about this from a year-over-year perspective. So when we get to a year-over-year perspective, when we get down here negative, we can identify that that's been about enough of a sell-off in margin to be able to correlate to market bottoms. We're not quite down low enough yet. We're getting close, but we're not quite down low enough yet. And I think that's an important thing for us to consider.